I'm extremely excited. I think there's many multi-baggers out there currently, and I think they're in our fund right now.
The market is flashing extreme fear, but this episode is all about optimism.
When things are tumultuous, we're just looking for the biggest opportunities.
We've got Jordan McNamee, winner of a Canadian Hedge Fund of the Year award last year and one of our top stock pickers in 2025. His fund is down in 2026, but he says this is the best buying opportunity he's seen since the market got crushed in 2022.
We have gone into this fear-oriented market, but the fundamentals of our businesses are actually doing exceptionally well.
How would you characterize 2026 in terms of buying opportunity? Are there parallels to 2022? We were worried about Uber and what autonomous vehicles meant for Uber.
And we will be talking about this forever.
Carvana is up 31% since you picked it. Cut to now, another short seller report. Talk to me about where it sits in your portfolio, where your conviction is. When you choose a Raymond James advisor, you're getting more than independent financial management. You're getting access to complete financial guidance under one roof. From tax and estate planning to trust services for generational wealth and strategies for life's key milestones like buying a home, funding your children's education, or preparing for retirement, they bring it together in one financial plan. What also makes Raymond James Advisors unique is their complete independence. With no proprietary product to promote, you will benefit from personalized services, all backed by the strength and resources of Raymond James, a powerhouse with $100 billion in assets and over 520 advisors nationwide. Discover how Raymond James can help you live a life well planned. Visit raymondjames.ca. The content provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and guests are their own and do not necessarily reflect the opinions of any organization or company. The host and guests may maintain positions in any securities discussed on the podcast. Always consult with a qualified financial advisor or professional before making any investment decisions. Hey everyone, welcome to a brand new episode of In the Money with Amber Kanwar. We are back in the studio after March break. I had a little bit of fun in the sun, as you can see, if you're watching on YouTube. The break is definitely over though. I can look outside and I see some snow falling off camera. My middle child has been vomiting pretty much nonstop for the last 12 hours. And the market has been doing its own kind of regurgitation. The S&P 500 is down 4 weeks in a row. It broke below its 200-day moving average for the first time since last year. It's against this backdrop that we've got Jordan McNamee of the Optimist Fund. And I enjoyed this conversation. I've been accused of having toxic positivity myself. And that's kind of what Jordan is. He's an optimist. He's looking for opportunities. And he's no stranger to big drawdowns. His ability to weather them have earned him accolades. In fact, last year, he won a Canadian Hedge Fund Manager of the Year award, even though when he started out in his own fund a couple of years ago, he started out with his fund dropping 50% right out the gate. It has since made up those losses, and he's walking into 2026 with another year of big losses. He says this is the buying opportunity. We go through a number of names that have been hit, whether it's related to the AI scare, whether it's related to the Iran scare. He says this is probably the best time after 2022 to start adding to select names. And of course, as always, he gives us those names. He also tells us what he got rid of. So there are certain things that he did think, okay, the thesis changed. I don't need to stick around for this. So a great stock picking conversation. And we're still doing our swag giveaway. I'm loving reading the comments. I read them on March break. If you want this market cap or this liquid assets mug, all you have to do is be a subscriber, comment wherever you're listening, and we'll pick one lucky winner every episode. All right, let's get into it. Jordan McNamee, thank you so much for joining us on the podcast again.
Thanks for having me.
So I don't know if you know this, but you were on pretty much a year ago, exactly.
Yes.
And we titled your episode back then, because your company is the Optimist Fund, but we titled it An Optimist's Guide to a Market Sell-Off. And I feel like maybe I can just copy and paste that. Because we're in kind of a tumultuous time for the markets. And so I'm curious from your perspective, because you do traffic in concentrated positions, high conviction positions, growth positions. How is your optimism level right now?
I would say it's the same as it always is, which is we're focused on exceptional businesses run by exceptional people where we think they're really underappreciated. And it's funny you bring a year ago when I was here, that was pre-Liberation Day. So like we were talking about how things were getting tumultuous at that point. And then Liberation Day happened and we had like material sell-offs that created a lot of opportunity. And so it ultimately ended up benefiting our fund performance because we were able to buy Carvana, which went down 30% from when we talked about it in the first episode. So we just do the same thing. When things are tumultuous, we're just looking for the biggest opportunities to.
And you know, like I should say, I'll give you your flowers. You ended up winning a hedge fund award, the Canadian Hedge Fund Award, because of your performance, in part because you took advantage of that volatility. And perhaps more importantly, you were a top stock picker on our show with your average returns of 90% on your pro picks. So stay tuned for his pro picks later on in the show. But as you look at that, and you talked about the volatility of last year, like what was key to that? What themes did you lean into that helped create that level of outperformance?
Really the businesses that we focused on, people were underappreciating how fast they were going to grow and how profitable they would become and how much progress would be shown last year versus people's expectations. And so that's ultimately what happened. Like the Carvanas, the Wayfairs, I'm sure we'll go through it. They all grew much faster and were more profitable than people expected. That drove a re-rating in the shares.
Well, now that I've softened you up, let's get to some hard-hitting questions. 2026 has been a difficult year for you.
Yep.
Your fund, and you've been public about it, is down more than 20%.
Yes.
And we're only, 3 months into 2026. That's a bad year for some people. It's definitely a bad 3 months. What's going on?
Yeah, that's a good question. A lot is going on. So since we're very focused on these ambitious oriented businesses, we're really focused on what is going to generate the most attractive returns over the next 5 years. And so we concentrate a lot into higher growth businesses that have more ambitious investment plans. And so a business like a Wayfair, a Carvana, a ThredUp, like I've spoken about before, in February, it's funny how now we're talking about Iran, but in February, it was all about AI. AI was destroying everything. AI was going to make everyone unemployed, kill every business. And so we have gone into this layered fear-oriented market where February was AI, now March is Iran, but the fundamentals of our businesses are actually doing exceptionally well. They're accelerating, growing faster than I expected, are more profitable. So this is part of the strategy. Like this is why we were able to compound it at nearly 20% a year for 4 years, is because we are not trying to optimize month to month. We're focused on what makes the most sense to make us the most money over the next 5 years. And so these bumps are normal.
It's interesting you talk about the growth rate essentially being unchanged in some of your stocks. I read a report this week, I think it was Mike Wilson at Morgan Stanley, who talked about the fact that since the October high, the multiples on the S&P 500 are down 15%. So we're not at a price correction for the S&P, but definitely we've seen a multiple correction. Multiples are coming down, but earnings estimates are going up. And it sounds like, if that's the recipe, and if you think those earnings estimates are going to continue to go up and be untarred by geopolitics or AI, I mean, that seems like we do what we've been doing for the last 15 years, which is we buy the dip.
Yeah, I think there is definitely a lot of change, though. And so I'm sure some companies will be impacted by AI negatively. I'm sure some companies will be impacted by the large increase in commodity prices because of Iran negatively. But there's a lot of businesses, at least the ones that I'm seeing, that are going to have very little impact, and their businesses already were fundamentally accelerating because of other drivers that were happening. That makes us really optimistic of what we're seeing. I
think it's fair to say, though, that your fund, your style of investing needs a risk-on environment.
A risk-on, if we say that the history of economic growth is a risk-on environment, then sure. I guess on a weekly basis, if we're going to say it, then yeah, I guess we need a risk-on environment. But I mean, The risk off environment for sure is when our companies will sell off. And so I guess it's a fair point. I struggle with it because I don't view the companies we own as like
risky.
highly risky. I view them as exceptional businesses run by people that own huge stakes of the business. And so everyone's perception of them being risky is actually why I view them as less risky, because that's what creates this like underpricing that will drive higher returns over 5 years.
I guess the reason I'm asking that is they tend to be more expensive, right?
On a near-term earnings basis.
On a near-term earnings basis, they tend to be more expensive. And so whether Iran matters directly or not to your portfolio, it is affecting something like the interest rate environment, right?
Yeah.
Now everybody thinks, well, because inflation will be higher, we're not going to get rate cuts, and we might even get rate hikes, which was not consensus before we came into 2026. And I'm thinking about your worst year was in 2022.
Yes, it
when
was.
the rate environment changed. Are you preparing for that potential scenario in the portfolio?
So there's things that are similar about 2022. There are things that are very different. So 2022 was very bizarre because of 2021 was the reopening year for the pandemic. And so a lot of businesses were investing aggressively, were not profitable in 2021. Then interest rates spiked at a very aggressive rate from 0, which slowed the consumer, which created this double whammy of like weaker top line and then everyone having to get more discipline on their costs. All of those businesses have already become significantly more cost disciplined. So there's not this like rush to prove out your economics on really any businesses currently. There are elements that are similar, but again, like I get this makes us different. Frankly, it's the reason why I started Optimist is we're thinking about generating exceptional returns over 5 years. Like that's, if you were an entrepreneur and you decided, hey, I want to make a lot of money for my investors, let's go have a business idea to generate a lot of value over 5 years, you'd be thinking about the business. Less so about like whether the interest rate environment is going to change significantly over the next 6 months. So could it impact us negatively? Sure, of course it could. It's impacted us negatively so far this year. Is it going to matter when Carvana sells 3 million cars in 5 years? I do not think so, because their profitability will be enormously higher than it is today under that circumstance.
Now, I promise we will talk about Carvana later on in the show, but I want to stick at the high level. How often are you changing out stocks or adding to positions or shrinking positions?
Adding and shrinking quite frequently.
Okay.
We've had about, I would say 30% turnover on an annual basis of the fund. So we always, like we look at it as our top 10 holdings are like our starting lineup, and then everything below the top 10. So we own 17 companies today. The 10 to 17 is like our bench players. So we call them the hungry bench warmers. They're trying to get on the court.
Yeah.
And so those turn over more frequently because we'll buy a position and then it's either tracking in line with what we expect or it's not tracking in line with what we expect and we move on from it. So yeah, about a third of the portfolio changes a year, but we really hope to own everything for it is like 5+ years.
Call it at the beginning of March when the recent tumult began around Iran. What changes, if any, did you make in the portfolio? What kind of recalibrations, or, because you're an opportunist, what opportunities did you take advantage of?
We've made more changes in late February during the AI sell-off than we have since the Iran sell-off. And so we recently bought a position in a company called Toast. They're a leading restaurant POS provider. They have a 20% market share in the US in the small, medium-sized restaurant category. This business went public in 2021, was a $60 stock, was growing exceptionally fast, had negative earnings. Then they went through this 2022 period that we discussed where went from $60 to $13. They had to get to free cash flow break even. Now we fast forward to today. They have over 30%. They have about 30% free cash flow margins. They are still growing high 20s%. They have $2 billion of ARR. It's trading at about 14 times free cash flow for a business that I would argue is like the Shopify of their category. And so we've been doing a lot of work in incremental software areas that have been significantly impacted. But in terms of Iran, nothing specific to Iran from like a new position perspective. But we do what we always do, which is sell positions that have held in better to buy positions that have been more disproportionately impacted.
That's interesting about Toast because, it was certainly hammered into the end of February, got a little bit of a bounce in March. I often think when we're talking point of sale, I think about Canada's Lightspeed. Did you do like a comparison? Was there a reason that Toast came out ahead of Lightspeed, which has had its own very difficult challenges?
Yeah, Lightspeed's business is much more diversified in a lot of different areas. So it's much more like their US business is more retail centric. The restaurant POS business is more Europe centric. Toast is an extremely focused business, which just focused on SMB restaurants and then dominated that in the United States. And that is what created a very dominant and attractive economic business. And so that's what we love about it, is that they are the leader in a category, the most profitable in that category, and growing the fastest. That's a rare combination where you're number one, growing the fastest and the most profitable. That's what they have. So that's why we think it's a really attractive asset.
So it's interesting. You're taking advantage of an opportunity created by an AI scare. And you're right. Before Iran, it was AI. And I would argue still is.
It is, yeah.
And it has caused a lot of dislocations, you can call it, in the market, not just in tech stocks, not just in software, but in asset managers, in financials. And do you have like a schema, like a way that you're thinking about this to help guide you to decide, okay, this is an opportunity, this definitely is not?
With regards to AI specifically?
Yeah, the AI scare that it's just going to take over software, eat into these businesses.
Yeah, I would say we're focused on areas where we're seeing their core business outperform on an existing basis, and that AI is more of a potential opportunity to them versus it's something that is like going to directly impact their core business. So we haven't jumped into like the heart of, I would say, the debate. Like we don't own like a call center business, for example. But we're watching them closely, frankly, because there's just so much change that could happen that will result in very large companies if the change happens as people assume. And so I'm very interested to see how it plays out. But so far we've been focused more on the businesses where their core is like significantly outperforming today and there's not really a core threat to the core.
Is there like an example?
Yeah, like I would say Zscaler is another business that we bought recently, which is a leader in cloud network security. They are effectively the Palo Alto of on-premise to the cloud. It's run by a guy named Jay Chaudhry. This is his fourth company. He owns 40% of the business. It's about a $20 billion market cap company. They have sold off about 50% in the last 6 months. It's a very attractive valuation, still growing over 20%, and just a leading business that I am very skeptical anyone will be vibe coding anytime in the future.
Because it is like, it's a tricky thing to vibe code. It's a network
business. Yes. Like you actually need to build, it's effectively a toll road of IP traffic. And so it's not a user interface that someone's just trying to replicate so that someone can organize a sales funnel. It's actually like core infrastructure for a business. And so it's just not something that's going to be like, there's risks, of course. Like AI could change potential threat surface areas that could become more important in the future, which another business could then have a better focus towards, which could steal budget from Zscaler to them. Like those are the things that could happen in the future. But in terms of like someone's going to create a lovable competitor to Zscaler. Like it's very, I do not see it happening today, and it's baked into the stock as though it will.
Did you punt anything from the portfolio as a result of the AI scare?
I did, yes. So we did own Monday.com. And so Monday has been in the AI scare because it is a core workflow tool that you could vibe code something to replace Monday. That's not actually happening, frankly. But the business, Monday itself does a lot of customer acquisition through online channels like Google. And they have had lower efficiency through their Google channel over the last 6 months as Google has been changing things with AI answers instead of regular blue links that businesses will pay for. And so that adjustment has resulted in them not forecasting their business as effectively as I would expect. And you do it once and it's like, okay, well, now set the low bar and make sure that you hit it. You do it twice and I lose confidence in their ability to actually forecast their business. And so that's why we sold the position.
Oh, interesting. I mean, that one has really plunged. Their growth rate has also slowed, but that's not a name that you're willing to step in front of here. What would you need to see?
I would need to see their growth reaccelerate and them dramatically beat the expectations they're putting out to the street. So for companies we invest in, we want a management team that's aligned. Monday has that. We want them to be a leader in a category that is significant and growing. Monday has that. We also want to trust that the management team is good at forecasting their business. And so that when they tell us information, we are very confident in that information. If that starts to slip, we lose confidence in the management team, and then we lose a lot of confidence in the management team. It's difficult to then say, oh, this company should be here in the future if they can't figure out where they're going to be in 6 months. So I would need to see them dramatically beat their own internal expectations over the next 12 months to even consider putting incremental capital into that position.
It's funny you mentioned vibe coding, which is basically like you don't have to be a programmer. You just type in this, I want a website, I want an app that looks like this and does this, and then it just pops up and does that.
Yeah.
And I've been like, whoa, this is so cool. But then there are limits. There's always like one or two things that are off that like the program can't seem to figure out, and I can't use it.
Yeah, making software is a lot harder than people think. It's like it actually requires a lot of product knowledge and a lot of work. And so it's not like really a side hustle to just be like spinning up all this incremental software tools. Like I know some people are going to do it, but just the majority of people who use software are consuming, just like I'm sure all your viewers that are watching this podcast, not all of them are going to then go and make their own podcast because they would do it and then realize, oh, this is actually a lot more. Yeah, I can make one episode, but to make this good on an ongoing basis takes a lot of work, which most people, it doesn't make sense to do. So I really believe that like software will still be a scale business, which is what it's always been. Like you make a piece of software, you do it once, and then you can sell it to millions of people and you have infinite leverage on that development. I think that's always going to be the case. But right now, everyone is all of a sudden saying, okay, the cost to develop is lower. We can try to start to make something much easier. So let's go and try. And so there's a new collection of upstarts of people that are going to try to build new stuff. But I think the end game will be the same, which several companies will dominate their particular category that they're good at. And like it'll be the same as what SaaS has been.
We talked, last year we talked at length about how you started your fund in 2022, which was a terrible market, and your fund immediately went down. And you're walking in 2026 down, but at least you've had the benefit of an 83% year, a 67% year, right? You did a lot better in these subsequent years. How would you characterize 2026 in terms of buying opportunity? Are there parallels to 2022?
I honestly think there's a lot of elements that are more attractive. There are similarities and there's differences. So I would say the parallels would be that the level of sell-off that has happened in a lot of growth-oriented mid-cap companies has been on balance, like similar. Like Uber on a price to sales basis is the same today as it was in 2022. But they're generating $10 billion of free cash flow now. And at that point, they were generating zero. So there are similar levels of sell-offs that have occurred, but the maturation of the business model, the profitability, like all of the health metrics of the businesses that we're focused on are significantly more attractive today than they were at that point. And so I'm extremely excited. Like I think there's many multi-baggers out there currently, and I think they're in our fund right now.
All right. Well, with that, let's see if we can go hunt for some opportunities and dip into the mailbag. All right. Our first question in the mailbag, we were just talking about Uber, is about Uber. The question is from Louise on Instagram. Uber has pulled back seemingly on no news. Is it a buy here?
Yes, it is definitely a buy here. Uber is, their growth is accelerating. They are generating tons of cash. They are doing an exceptional job on an execution front. There's significant forward growth, and it is trading at almost 10 times free cash flow at this point. So it is an exceptional opportunity.
Now, we think about Uber, ride hailing, the Eats business. Yeah. I've seen notes that do this thing with kind of futuristic companies about, well, that's not why you're buying it today. there's a big autonomous vehicle play, and you got to look out to their ability to reach those goals in 4 or 5 years. How do you think about that part of the business? Because I think even last year we were talking about it. We were worried about Uber and what autonomous vehicles meant for Uber. Is it disruptor? Is it disruptive, or will it help them be a disruptor?
And we will be talking about this forever. It will never go away that autonomous vehicles could be a potential disruption, just like what Google does with Booking.com is always a potential, is Google going to get into hotels and disrupt Booking.com? It will always be a thing. So today, Uber's strategy is to be a network, to be the best matcher of supply and demand. How they have done that has historically been through millions of riders, millions of drivers, as you know. On the autonomous side, they have done partnerships with Waymo. They've done partnerships with many other autonomous companies. And their view is it is another form of supply that is going to add to their network. And so far, autonomy is part of their strategy. It's part of their business. There is one scenario in which Uber would be very negatively impacted 10 to 20 years from now if Waymo decides to not partner with anyone, to own all of the vehicles themselves and control all of the distribution of those Waymo vehicles. And then all of those Waymo vehicles significantly steal all of our cars. None of us are driving cars, and we're just using Waymo. Under that scenario, that will be bad for Uber. Their Eats business, though, would actually still be much larger in this 10 to 20 year dystopian future. And so that is a risk that we will always talk about, we'll always manage. It's more than reflected in the price. And if you just look at their fundamentals today, they're growing free cash flow 30% plus a year. They're growing bookings 20% plus a year at over $150 billion of bookings. This is enormous growth for this size of company. And if you were to shut down Uber today, cities would panic. Like it would have a dramatic impact to a city. And so we like it a lot. We think it's a really attractive investment.
How does something like higher fuel prices affect, I mean, not the business directly, obviously, because they don't own anything. They don't own, they don't even employ the drivers in most states, in most places. Those are costs borne by the drivers. But I imagine the cost of getting food, of getting a ride will go up because of it. Do you think about that as material?
I mean, it's had transitory impacts many times in the past where pricing, like if we look back to in 2021, 2022, the cost per Uber ride went up significantly because of inflationary costs. And so the core thing about Uber is it is a matcher of supply and demand. That's fundamentally what it is. And so if all of a sudden supply is challenged because drivers are saying, I can't make any money, then they will make adjustments. And so it's something that it matters on a year-to-year basis. It can have some impact, but it's not going to be material to the core thesis over time.
Another question we have in the mailbag is about Latham Group, maker of pools.
Yes.
Which is fun heading into summer. Hopefully we get some more weather. This question from Josh on X: will Latham Group ever get back to 2021 levels? Do you own Latham?
Yes. Yeah, we own Latham. So Latham is a leading manufacturer of fiberglass pools in the United States. The pool industry, pool construction, has been a horrible, horrible place to be for the last couple of years. In the pandemic, it was a great place to be, as you would imagine. Latham went public, was owned by private equity, went public in 2021, was like a $30 stock. Then interest rates went up, pool construction. All of a sudden, everyone who was going to put in a pool decided, maybe I'll wait. So pool construction went down 50%. That obviously hurt Latham's financials. Their profits went down 50%. So their stock went down 90%. Yeah. And so that is when we got interested because what we saw was, this is a business that has about 50% market share in their market. They had like really attractive historical growth, good historical execution, but their industry was like in the doldrums. And so today you're buying a business that today is growing profitability in the mid-teens on a much lower base of overall pool demand. At some point, overall pool construction demand is going to get back to 2019. When that happens, Latham's profitability is going to explode, and I think this will breach its highs from 2021 and be a very strong investment.
They just did an acquisition, right? Freedom Pools?
They did, yeah.
And the market seemed to love that.
Yeah, they did. Well, they liked the acquisition, but it was more so that the guidance was quite strong.
Yes.
So that they
and then it gave it all up. Then
obviously then Iran happens and AI is going to make it so that we know no one has pools. We're all just going to be in the metaverse. Although that got close, so maybe not.
But long term, you think it's additive to that thesis?
Yeah, I think that they could have like right now with no growth in their end market, they're going to grow profitability in the mid-teens. When their market gets back to 2019, right now about 60,000 pools are installed in the US a year. In 2019, it was about 90,000, between 80 and 90,000. And so when they get back to that level, this is a manufacturing business at the end of the day. So a 50% increase to their top line has a disproportionate impact to their underlying profitability. Profits are going to explode in that scenario. So we're very excited about just owning a business that's going to, in this horrible scenario, keep compounding along. But if we get back to where we were pre-COVID, which we have in most other sectors, but pool construction we have not, this is going to be a very strong investment return.
Is it too expensive?
No, not at all.
Well, I'm just going Bloomberg estimates, 34, 35 times future earnings for just mid-teens.
No, the thing is, this is a small cap. It also has a ton of amortization from the acquisitions they've done. So the numbers in there are typically quite messy. Like this business could do $2 in earnings in 5 years.
We have another question. This is about buy now, pay later. Yep. Specifically asking about Affirm, but the question is, why is buy now, pay later struggling when the lower end consumer is supposedly struggling? Shouldn't it be a beneficiary?
Yeah, so buy now, pay later is not struggling from a fundamentals perspective. It is doing very well. Affirm is growing rapidly at very attractive returns. Their profitability is attractive, and they're still significantly underpenetrated in the United States. And so the industry is doing very well. Now, why the stock has corrected is back to what I was saying before, is they are a business that is viewed as higher risk. They have multiple different funding sources. And when all of a sudden people get into this risk off period, they think, oh, okay, well, their cost of capital is going to go up. That could impact the profitability. And so it is a stock that's more volatile, but the core fundamentals are actually extremely strong.
So this is an interest rate sensitive stock.
Yeah.
And so when you believe that interest rates could potentially be going higher. I mean, I say that, but I mean, it was trending lower even before
it's gotten pulled into the AI growth scare. It doesn't really make much sense in my opinion, frankly. But it's moved similarly to all software businesses that are supposed to be getting replaced by AI. So I think it's extremely attractive. Like they're doing exceptionally well.
You were talking earlier about like how you pick amongst the wreckage. Yeah. In the AI sell-off, and you want to make sure the core business is intact. Yes. And this seems like
This is one. Yeah, we've been adding to this one.
A final question in the mailbag is Teledyne. Well, it's really about the defensive sector, which I don't know how much you play in, but why hasn't the defensive sector outperformed amidst the war in Iran? This one coming from Joe and Milton.
So why it hasn't outperformed in the war in Iran? Less sure on that near-term basis, but if you look year to date, they have done quite well relative to a lot of other sectors. So Teledyne is a fantastic business. It's run by a guy named Robert Murabian. He has been running the company for over 20 years. He has compounded at about 20% a year for over 20 years, and they are very good at operating these industrial technology businesses and acquiring new ones. And so, yeah, their financials are strong. They're doing well. And frankly, it is like, I think it's up 20% year to date. So it has been bucketed into this category of this is safer. We feel good about its future growth. And so I wouldn't say it's under, well, I guess it's probably down, 7% in the last couple of weeks or something like that?
Yeah, which is when the war started.
Yeah,
so I think that's where people have this sort of disconnect. If you're thinking about where am I going to park money, you would go to defensives, but maybe it's doing poorly on a relative basis just because it did outperform so much the whole sector did.
Possible. I mean, it's not a pure defense business. Like it's probably about 25% of the business is government. So that's not like the whole business. A lot of it is other like industrial applications that are just relevant to commercial activity. So maybe that would be the driver. But if you look at the long-term fundamentals of this business, it's a really high-performing organization.
So you own this one?
We do own it, yeah. And but this was a good example of a business where it's held in much better this year, and so we have been trimming it and buying the Affirms of the world that have sold off significantly because it's just a really attractive relative trade currently, in my opinion.
All right. Well, let's get into some of your highest conviction ideas, and we'll review your pro picks from last year and get some new ones. Pro Picks is brought to you by ATB Financial. With over $100 billion in assets, ATB Financial is powering possibilities for more than 843,000 financial services clients. ATB Cormark Capital Markets is a leading North American investment firm providing holistic corporate and capital markets advice and full-service financial solutions. Visit atb.com/inthemoney for more information. So before we get into your pro picks, this is where we're finally going to talk about Carvana. Don't worry.
All right.
Your last time you were on, March 4th, 2025, you picked Carvana, you picked HelloFresh, and ThredUp, which is you're coming back with ThredUp.
Yep.
Carvana is up 31% since you picked it. Mm-hmm. And the last time we were on, we were talking about short seller position, and you said, it was playing in kind of misinformation. You were very bullish. You said it could be a $1,000 stock over the next 5 years, and it was a big position for you, 20% of your fund. Cut to now, another short seller report, this time coming from Gotham City Research, and the stock has been dented, but as over the course of the year, still up 30%. Talk to me about where it sits in your portfolio, where your conviction is.
Yeah, so it's a top 3 position. It's our second largest position right now.
Okay.
So still extremely bullish. I think in the next 5 years, it'll be a $1,600 stock.
We're even more bullish.
They're doing better than I expected a year ago.
So it's a $300 stock now.
It's a $300 stock, yeah. So they are growing still. They're selling 40% more cars currently than they were a year ago. They are going to become the largest used car dealer. They were the number 2 for a while, second to CarMax. They will cross CarMax this year with a profitability profile that's double the industry. And there is like a very large grouping of short sellers that have been talking negatively about Carvana since it went public effectively. And the short reports have effectively been a collection of the same arguments for a very long time. And Carvana has just done an exceptional job proving them wrong by just delivering on the fundamentals. So,
I mean, it would be a clean story if they were just an online used car retailer, but they do have a financing business.
Yes.
And this is the part that the short sellers like to go after. And in the most recent Gotham City report, they suggested that the earnings were overstated by, I think, more than $1 billion. And basically suggesting that they're dependent on related parties. So the part of their financing business is called Drive Time, right?
Yes.
It's separate.
That's not part of the front. That is Ernie's dad's business that funded Carvana in the early days.
Yes, so that's where
it's so nuanced.
It is nuanced.
Yes.
It's separate.
Yes, it is separate.
If you're buying Carvana, you do not own Drive Time.
You do not.
However, those two businesses work together. And as you said, Ernie's dad is that business. So,
he is.
So help us understand why that's not a sketchy situation and one where they're not inappropriately leaning on each other to bump up some of those figures.
Yeah. So Carvana used to have negative margins. They burned cash. And at that point, everyone said, Ernie's dad is stealing from Carvana, and Carvana has negative margins because public market investors will fund these losses and then send all the money to Ernie's dad. That's what people said before. So Carvana was a bad business, looked horrible, financials looked horrible, and Ernie's dad was running away with all the money. Now Carvana has the best margins in the industry, is minting money. So now the argument is the opposite. Now the argument is that Ernie's dad is funneling money into Carvana to prop up Carvana's profitability and create these fake financials. So the narrative effectively has completely been the opposite. They've just completely flipped. You can go through all of the financials, the information of what they disclose. Their financial partners, Ally Financial, pretty sure the largest investor in Ally Financial is Berkshire Hathaway. They were definitely a top 10. So this business didn't go public yesterday. It went public years ago. And so there has been so much scrutiny going through all of the different arguments that have been the same effective argument for 8 years now. I mean, I can go through the neon, but the point is that
especially in the light of I don't think you ever owned like a Go Easy.
No.
But we've had people on the show very convicted on a Go Easy, very dismissive of short sellers.
Yeah.
Again, Go Easy was like really targeted for shorts.
Yeah.
And again, this one was dismissed, and like a lot of what the short seller was alleging in Go Easy did come true. So I think it is important to go through some of the details.
One of the claims he said, where are they benefiting from better terms with Ernie's dad's financing company by having lower servicing rights? If you go through the report, that's what they'll say. Oh, the servicing fees that they pay are below market, which allows Carvana to earn X percent. The math is fundamentally wrong if you go in the short report, the math is not correct when they're measuring the portfolio that they're servicing. So they're using incorrect math to then draw a conclusion that looks negative. It's just not correct math. And
so the servicing fee is industry average?
Yes. Okay. The servicing fee is industry average.
And I guess different from Go Easy, Carvana didn't delay their earnings report, and there hasn't been any change to their forecasts?
Change to their forecast? Well, they gave a new guidance for the year because the year ended. But again, it's the same. Nothing from the report is new. So it's effectively, do you think that they are giving a good customer value proposition to customers? Do they sell cars at a profit and attach a loan product to that car, which, is very common in the industry? And then are you comfortable with the profitability they're making on their loans? They're all ABS transactions. So you can look through the quality of the portfolio and come to your own conclusion. People can come to their own conclusion. I'm not telling short sellers they should think differently. I'm just saying, from what I see, I have just seen an absolutely exceptional business run by an incredible team that is building what I think will be one of the largest companies in the United States. So
you're not concerned?
I am not concerned about the short. Again, if I was concerned, I'd be concerned last year. I would be concerned the year before. I'd be concerned the year before that. The short report never changes. It's the same argument every single year.
And you said Carvana has been public a while. This drive time arrangement is also not new.
The drive time arrangement is not. Drive time founded the business.
That's right.
That is Ernie's dad's company. So that Ernie convinced his dad to fund him to create this business that is now going to be the largest used car retailer in the United States. I don't know if anyone knows any used car retailers. It was their grandpa's company.
Yeah.
Ernie has become the number one player in less than 15 years and is growing faster and is double industry profitability. Or go to the US, use the product. Interact with the business and then figure out whether or not you think what they're doing makes sense. But there's just they provide so much information to understand what's happening in the business. So yeah, we like it a lot, and it's a fantastic business. They own 40% of the company. They're very much aligned, and just encourage them to keep executing on doing what they've been doing.
Your second pick didn't go as well. This was HelloFresh.
Yep.
Meal kits down 66% from when you last chose it, or from when you last spoke about it.
Yeah.
Understanding your returns are definitely different. But you talked about, obviously meal kit demand has dropped off since the pandemic. You see it in HelloFresh, you see it in Good Food, and you acknowledged that last year. But you said we're at a profit inflection story.
Yes.
Which I guess has been true. There's been bouts of profitability since then, but sales are still falling. And so do you still own this, or did you get rid of it?
No, we sold it last summer.
Okay.
So the profit inflection that we were anticipating, it had a little bit of a wobble in the summer, which we were uncomfortable with. And so we exited the position.
And you're not going back to it?
No, we're not. So this is a really important element of our strategy, is we are very focused on what's happening how things are tracking and whether or not it's in line with our belief. Because as you can imagine, we own Carvana today, it's $300, and we think it's gonna be worth $1,600. There's a set of assumptions that we believe are going to happen. And we're tracking that very closely. If all of a sudden things are different than our assumptions and it changes the confidence we have in that upside target, then we'll exit the position and buy something else.
Okay, so your third one was ThredUp, and I thought I've never heard of the business. You're the one who put it kind of on my radar. It's up 36% from when you chose it. You're bringing it to us again as a top idea, and the opportunity is that it's down 70% from August. So yes, it's up kind of from March to March, but there's been a lot of volatility in between. Just remind us what the business does, and then you can tell us why you're so excited about it.
Yeah, so they are an online consignment store. So if you are a woman between the ages of 25 and 45, there's probably things in your closet that you are thinking, I am going to get rid of this. And you have several options. You could put it in a garbage bag and bring it to Goodwill or Salvation Army or Value Village, or you could post it on Poshmark or a different online marketplace and do a lot of work and then sell it to someone. The third option would be you send it to ThredUp. And so ThredUp is the in-between of these, where you get less proceeds of the sale than you would if you sold it on Poshmark, but you do no work. You just send them the item, then they do all the process of selling it and whatnot, and then give you a cut at the end. And so that is what the business fundamentally does. It is a very challenging business to do, because you have to take all these clothing, take pictures of it, make sure it's the right clothes, make sure it doesn't have stains all over it, make sure like people are going to want it, then post it online, then store it, and do that for millions of people across the United States. So it's very labor intensive. It's a very challenging business, but they have cracked the nut and are doing an exceptional job.
And yet the stock is under pressure. And I know there's growth concerns. They grew very quickly last year, and they were warning that this year they're not going to grow as much.
Yeah, they weren't really warning that. I mean, a year ago, they guided that they were going to grow 6%, and they ended up growing 18%. And then this year, they've guided that they're going to grow 13%, while still expanding margins, similarly to what they did last year. And so the business is doing exceptionally well. I believe they could grow 15 to 20% top line for a long time at an attractive incremental margin that will drive earnings growth in the 25% plus range for a long time. And so I think it's more of a situation, first off, it's obviously still done well in the last 12 months, but a few things that people have gotten mixed up with this stock. One is they thought that tariffs like disproportionately actually drove their growth. And then when the Supreme Court was talking about turning the tariffs, now when that happened, people all of a sudden thought, okay, they're going to get hurt by it. And that was just never really like a material driver of their year.
I don't think if I'm going to clean out my closet, tariffs have nothing to do with it.
Yeah, well, then people will make the argument, oh, okay, well, they must have benefited because if now t-shirts are 30% more expensive, then I'm going to buy resale. Resale will be more value. The reality is that did it have a benefit? I'm sure it had a benefit, but the difference between 2 percentage points is just like, it's really like not relevant to the long-term investment thesis of the business. And so there was like that element, and then obviously AI and the growth scare. But this business now is trading at one-time sales for a marketplace business that will have 20 to 25% EBITDA margins in the next 5 years. That is exceptionally cheap. I think this stock will be a $30 stock in 5 years, and it's what, $3.50 now. It would not surprise me if a year from now I come on the show and it's $15.
All right, let's see. I hope they come to Canada more than I hope that the stock does well, because that sounds like a great service. And they're still not, right? They're still just in the US?
You can buy, but you can't sell.
I know, that's what I want to do. I want to sell. Talk to them if you have the management. Okay, this one's really interesting. Your second idea is Wayfair. Why do we want a housing play in a dead housing market?
Oh, yeah, because it's been dead for so long. It's been like Wayfair has... So Wayfair, as I'm sure everyone remembers, had an incredible pandemic, and then it's had a very challenging time for now, I guess, 5 years. And we are finally at a point where the home goods market is no longer declining 10%. And so Wayfair's market share gains and their very attractive incremental margins are showing up in their financial results. And so if we go back a year, Wayfair was roughly flat, like the revenue was not growing, and they had about 4 to 5% EBITDA margins. And then if we look at what happened in the last year, they went from roughly flat to growing revenue 7% by the end of the year, and EBITDA margins going to about 7%. So they had a 60% increase in their EBITDA while growth is accelerating. And then for Q4 this year, they said, okay, well, what are we expecting for 2026? They think that trend will continue. And so this is the Wayfair that people knew pre-pandemic, which is like a business that's going to grow 20% top line. The difference is now, pre-pandemic, it wasn't very profitable. They were just focused on building out the business, expanding, getting customers. Now we're going to enter a period where Wayfair is high growth, high incremental margins. And I think over the next 3 to 5 years, profitability is going to absolutely explode. And so that is what we're very excited about currently, is that we've had this thesis on Wayfair for like 3 years. Yes. And we've been kind of it's been kicking the can down the road where it's like, oh, the industry's down 10% again. Okay, so if they grow 10% faster than the industry, they're going to be flat.
So when you say go back to high growth, like 2018, 2019, they're growing top line 40, 30%. Obviously, it explodes during the pandemic, years and years of declines. And now I'm looking at estimates that's looking for like 5% growth, which is better than a 10% decline. Does it go back to 2018 levels, or does it need to go back to 2018 levels in terms of the percentage growth?
Yeah. So I was expecting it to get back to 15 to 20% top line growth. That was my expectation at some point in the next several years when the actual home goods market gets back to its historical growth rate of around 4%. This past year, though, like 2 months ago, Neeraj Shah, the founder and CEO, wrote his annual letter, and he said that they expect to get back to 20% plus organic revenue growth. And so that is
this year.
Not this. He did not say this year. He said we're starting the year at +7, and we expect to keep doing better. And so getting back to 20%, the fact that he's comfortable saying that, because 2 years ago, frankly, he wasn't. He said, we think we can get back to definitely in the teens. Now they've gone from flat to 7%, and I believe are going to accelerate through the year. To get to 20% growth, this is going to be a $500 stock. Like it's going to be an exceptional performer. And so, yeah, we're very excited. This is a pendulum that has swung very hard in the other direction, and we are like literally first or second inning of it swinging back in the other direction, which will be which we're excited about.
Okay, $500 stock. It's an $80 stock right now, so we'll see what we're talking about next year. In 5 years. In 5 years. Okay. Yeah. Okay, fine. In 5 years, if I'm still doing this in 5 years, then we'll definitely talk.
Well, I hope so.
I'm sure that you'll still be doing this in 5 years. Okay, the third pick, First Advantage. And I'm going to stress test this one because what do they do? This like background screening. If you're hiring somebody, they help with that stuff.
Background checks.
And gosh, aren't we so nervous about hiring and jobs in America?
Yeah.
Why? And so why would we buy a company that is tied to that kind of precarious situation?
Yeah. So this is another situation where their end market has been challenged for since 2021. And so First Advantage went public in 2021 and hiring was strong. You do background checks and you hire people, obviously. And then they've had effectively negative organic growth from 2022 to until Q2 of last year, when they finally crossed the chasm of back to growing organically. And so this business, they have 25% share of the background check market. They're the leader. They did this acquisition with another player to make them the de facto leader. They actually were they were the number one player previous to this, but it was like a market where you had a 13% share, then you had another guy who had a 12% share, and another guy who had an 11% share. They were the 13, they acquired the 12. So they did that at the bottom of the market at an attractive valuation. Now you have the market starting to pick up. Against popular belief, I guess, hiring volumes have stabilized and are actually picking up on a sequential basis. You can look at it. You can look at other public staffing agencies. They're all saying this, that like since December of this past year, they have been saying we have seen the market bottom and start to stabilize on a hiring basis. And so this trend we can also see in First Advantage's results is where they went from having negative organic growth to then going +2 to +4 to Q4. They grew 12% organically. This is a business that had been declining historically because the market has turned over. So now we have a situation where growth is accelerating. profits are accelerating, and the stock has sold off dramatically because of AI. Because AI goes, AI is going to replace it.
Not even replace it. They're going to replace jobs. You don't need to background check your AI bot.
Well, you might. Honestly, you might. That actually could be a growth avenue. Figure out if this AI bot actually has been successful in what they're claiming to do.
Yes.
No. So yeah, there are definitely these high level. It's all these high level doom and gloom statements. Just if we look at what's happening, what are their customers actually saying? Are they getting more money from their customers? Are they growing their earnings? All of that is telling us that this business is accelerating and trading at an exceptionally low valuation for a business that has historically grown organically about 10% a year. Earnings per share through a cycle should be 15 to 20%, but we should have like disproportionately high levels of growth right now because the market has been like this for 3 years.
Yeah.
And so if it's 15 to 20% over a long period of time, in this market recovery period, it can be extremely robust. And so that's what we're really excited about and paying a incredibly low multiple for it.
Can they do this? You have to believe that there is going to be a slowdown in hiring, or are you owning this because you don't believe that?
I don't really care if there's do I think that everyone's going to be unemployed? I definitely don't think that. Is hiring been horrible for years? Yes, it has. If it gets worse, so First Advantage just grew 12% with their core hiring volume of their customers still negative. And so why was that? It was because of different compliance functionality that they're able to sell to their customers to grow faster than the market. And so whether or not hiring gets worse on an incremental basis, I still think the business is going to grow this year. Earnings are still going to grow materially. If hiring gets better, oh my God, this thing's going to be a monster. And so, I mean, I think in all scenarios, they're going to grow earnings per share at a very attractive rate. And we're buying this company right now at like 9 times earnings. So we feel really good about it.
Okay. We do tell our guests not to pound the table, but I do feel like you pounded the table on some of your picks.
Like this one is just an exceptional risk reward.
Okay. Yeah. All right. Out of your mouth. Jordan, thank you so much for joining me on the podcast.
Yeah, well, thanks for having me. Always enjoy it.
Jordan McNamee joining me from the Optimist Fund. Don't miss our next episode. We are talking about U.S. dividend-paying stocks. We've got Amrita Kasturi-Rangan joining us. Franklin Templeton, if you've got questions, she's got answers. Email us questions@inthemoneypod.com. Find us anywhere on social media @inthemoneypod, and we'll see you on the next episode.